$7,000 a ton. Then $82,000. Then $8,000. Then $23,000. All in 6 years. No commodity on Earth moves like this. This is the lithium cycle, and it's turning again. In this episode, we answer 3 questions. First, why is lithium the most volatile commodity on Earth? Second, how did a 154,000-ton surplus turn into a deficit in just 18 months? And third, after prices doubled from the bottom, who are the key players for the next cycle? Lithium is the lightest metal on the periodic table and the backbone of every rechargeable battery. But this market has 3 structural problems. No futures contract, price discovery runs on opaque bilateral deals. Supply rigidity, a new mine takes 5 to 7 years. And demand compounding faster than any commodity in history. Battery demand grew 29% last year alone. Lithium isn't a scarcity problem. It's a timing problem. In 2020, lithium carbonate traded near $7,000 a ton. Then EV demand exploded. By November 2022, prices hit $82,000. Then the crash, mines that ramped during the boom flooded the market. By June 2025, prices fell 90% to $8,200. Bald Hill shut permanently. Intake Cattlin went to care and maintenance. Sigma paused in Brazil. Then the rebound. By January 2026, lithium hit $26,000, 3 times the bottom in 7 months. Today it sits near $23,000. The cycle is turning. The question is whether it holds. Mining is dominated by Australia at 55%, Chile at 23%, and China at 14%. But 97% of Australia's spodumene goes to China. And China controls 80% of lithium chemical refining, 78% of cathodes, and 70% of battery cells. The mining is distributed. The refining is not. Batteries consume 88% of all lithium. The total market was $32 to $37 billion in 2025. The lithium triangle, Chile, Argentina, Bolivia, holds over half of proven reserves, but brine extraction is slow. Speed belongs to hard rock. In 2024, the lithium market had a 154,000-ton surplus. By early 2026, it's gone. The market shifts to deficit this year. Mine closures cleared the excess. Bald Hill shut permanently. Chinese lepidolite mines idled. The supply side self-corrected violently. Meanwhile, Rio Tinto made the biggest move of the cycle, $6.7 billion for Arcadium lithium, completed March 2025. Buying at the bottom of a 90% crash, targeting 200,000 tons per year by 2028. In my view, this was the strongest contrarian signal, the world's second largest miner betting big when everyone else was running. The table shows 10 companies across the lithium value chain. 3 things stand out. First, the turnarounds. Albemarle stock went from 49 to 206 in 1 year. SQM flipped from a $404 million loss to $588 million in profit. Ganfeng and Tianqi both swung from billions in losses to profit. The entire industry turned around. Second, Australia kept producing. Pilbara hit a record 754,000 tons despite prices falling 43%. IGO holds 49% of Greenbushes. Third, the next wave. Lithium Americas is building America's largest lithium deposit. Standard Lithium is testing direct lithium extraction at scale. These aren't revenue stories yet, they're option value. 3 Tier 1 players, 3 survival strategies. Albemarle cut costs 38% and held long-term contracts. Revenue, $5.1 billion. Stock, 49 to 206. Kings Mountain targets late 2026 production. SQM, the most dramatic turnaround. From negative $404 million to positive $588 million net income. Atacama is the lowest cost lithium operation on Earth. The Codelco joint venture locks access through 2060. Rio Tinto bought the crash. $6.7 billion for Arcadium gives Rio operations across Argentina, Australia, and the US. The most diversified lithium portfolio in the world, assembled at cycle bottom. Greenbushes in Western Australia is the world's largest lithium mine, 1.48 million tons per year at 325 Australian dollars a ton. The ownership is a puzzle, Albemarle 51%, IGO 49%, and Tianqi holds 26% through Talison. 3 companies, 2 countries, 1 mine. Its CGP3 expansion, 500,000 tons of new capacity, started trial operations in December. It's the single largest supply addition globally. The Chinese giants both turned around. Ganfeng, profit up 178% from a 2 billion loss. Tianqi, profit 463 million, recovering from a 7.9 billion hole. The cycle punishes, then rewards. Beyond the majors, 3 companies and 1 technology could reshape supply. Pilbara Minerals record production of 754,000 tons despite revenue falling 39%. Volume over price, a bet that only works if the cycle turns. Lithium Americas, Thacker Pass in Nevada, 93% engineering complete. 40,000 tons per year, late 2027. On time, it's the cornerstone of U.S. lithium independence. Sigma paused in October, restarted in January, targeting 240,000 tons in 2026. And the wildcard, direct lithium extraction. If DLE works at scale, it rewrites the supply timeline from years to hours. In 2025, over 20 million EVs were sold globally, 1 in 4 new cars. 2026 forecasts exceed 25 million. Each EV uses roughly 60 kilograms of lithium carbonate equivalent. Battery demand grew 29% in 2025. Regional prices show a fragmented market. Northeast Asia near 18,000. Europe near 12,000. North America around 9,400. The spot price sits near 23,000. Total demand in 2025, roughly 1 million tons. By 2030, 3.7 to 4.6 million, a 4-fold increase in 5 years. No commodity supply chain has ever scaled this fast. 3 risks could reset the bull case. First, capacity rebound. Prices above 20,000 trigger mine restarts. Australia expects 6% more production in 2026. Greenbushes CGP3 adds 500,000 tons. If supply rebounds too fast, the surplus returns as it did in 2017. Supply always chases price. Second, sodium ion. CATL is mass-producing sodium-ion batteries for low-end EVs. Sodium needs no lithium. If it penetrates 30% of those markets, lithium's demand ceiling needs revision. Third, China destocking. The price surge was partly trader stockpiling. If demand disappoints, destocking creates sharp drops. The pullback from 26,000 to 23,000 is a live signal. Base case, 55% probability, deficit in 2026, prices oscillate 20,000 to 30,000. Albemarle and SQM enter earnings expansion. Downside at 30%, mine restarts push prices to 12,000. Tail risk at 15%, sodium ion plus EV slowdown revises demand long-term. 3 signals to watch. First, Thacker Pass. On schedule means US supply is forming. Delayed, the narrative loses a year. Second, China spodumene import spread versus lithium carbonate spot. Widening means tightness. Narrowing means destocking. Third, Greenbushes CGP3 ramp speed, the largest supply addition globally. One number to remember. Every $10,000 move in lithium carbonate is $500 to $600 per vehicle in battery cost. Consumers don't see lithium prices. But lithium prices see every car. Next episode, solid-state batteries, $20 billion invested, still no product. I'm Big Z, follow me, see you in the next deep dive.